and I didn't know any funds. My family knew a couple of venture funds. They introduced me. I met them there. I think they were pretty reluctant to kind of invest. They're like, who is this kid? What is he doing? Everything was just like, you kind of make your own luck. I have this philosophy, like you have this grit and persistence, and then luck happens.
Hello and welcome to First Money In, a show focused on now extraordinary founders and their very first time ever raising venture capital. My name is Nicole Wishoff, and I'm thrilled to bring you our latest episode. Today we welcome Mark Ghermezian, co-founder and prior CEO of Braze, and also the founder of a venture firm based in New York called MXV. Braze, a now $4 billion public company, sells customer engagement software to businesses to manage their multi-channel marketing. Since launch in 2008 and until the IPO, Braze raised nearly $75 million from investors like Meritech, ICONIQ, and Battery Ventures. Join us as we learn more about the founding of Braze, growing up with a very successful family of entrepreneurs, and more. Mark, thank you so much for joining me for this episode. Before we kick into all things Braze, which is now a public company, I think as of today, they have a $4 billion market cap. We want to learn more about you. So pre-Braze, you have an interesting background in that your family is filled with very successful entrepreneurs. So did that give you the bug from the start, or when did all of this like starting companies madness start?
Yeah, definitely from the start. Actually, a lot of people don't know, but my first thing I did was, with my bar mitzvah money, I bought a vending machine. So I got about $3,000 and I took it and I bought a vending machine and I put it into an ice skating rink, and I put it into the mall and my family's shopping centers. And then eventually I got to like 5 machines by the time I was 15.
Were you stocking these? Are these good investments? I always wonder.
Oh, they're the best. So I was stocking them, and my mom was taking me, I grew up in Edmonton in Canada, a small town. So my mom was taking me to the Costco of Canada. We'd buy the snacks and pop, which is soda, and we would fill them up, and you'd make like $200 a week which is pretty awesome for a 13-year-old. And eventually I had 5 of them, so we were making good money.
How were you handling the accounting, or was it just going right into your bank account and you were buying?
I had to, the bank doesn't accept coins, so there wasn't really credit cards then, acceptance on vending machines. So I had to roll. I bought a coin rolling machine. I'd roll the coins, count them, put them together, and my mom would go deposit the money for me. But that was my first thing. But to answer your question, absolutely, I like watching my father do what he was doing, and the entrepreneurial bug was always there. It still is there. I love it. But I did that. Then I did ads in bathrooms in high school.
Oh.
Yeah, so I did that, and that grew to a fairly large presence. I moved to New York for school, and then I got all the New York sports clubs, Boston sports clubs. We were in 120 health clubs. We had the exclusive rights to all ads in their locker rooms.
I'm assuming these weren't digital ads at the time.
No, print. And then after that in school, I started an MVNO, which I think was what really got me into the world of Braze and the world of like technology. An MVNO is a mobile virtual network operator. So what you do is you buy minutes at wholesale from the large operators like AT&T, Verizon, and then you rebrand the service with your own branding. So Virgin Mobile doesn't own any network. They're piggybacking off of Sprint's network. Mm-hmm. And that was really the business model, and I did that. And that got me into the whole world of like tech, because I was into phones. I was like starting to buy stuff, and then the iPhone came out, and then I started Braze, but then it was called AppBoy.
Yeah, I was going to say, so take us there. So it was called AppBoy. Were you with your co-founder from the start, or did he start a little bit later?
So no, I started working on AppBoy probably 2 years before I brought on any external funding, or if I even bring on my 2 co-founders.
Was this the 2008 date, or was it prior?
Yes, in 2008. Okay. So I got married in 2008. I actually moved to Houston with my wife. My family was doing oil and gas there, so I was helping manage the portfolio of investments we did there. And at night, I was started to work on AppBoy. I just had this idea of like connecting developers of apps with users, and we were just building this website, and it was just me for a couple of years. And then eventually I'm like, you know what, I wanted to go to Austin. There was South by, and I never heard of South by. I just heard about it. I'm like, I'm in Houston, let me just drive there and see what the hell this is, see if I can raise money for this company. And I didn't know any funds. My family knew a couple of venture funds. They introduced me. I met them there. I think they were pretty reluctant to kind of invest. They're like, who is this kid? What is he doing? And eventually I met my first investor, Alex Lloyd, who is an angel investor. He was early in Zynga and a few of those social gaming platforms. Mm-hmm. So he kind of got what I was trying to build. I was trying to build like this.
How did you meet him?
I was actually meeting with a venture fund, and he walked by on the street. And they're like, go talk to Alex, see what he thinks. They're kind of like telling me to F off.
Right.
So I just ran over to Alex, and he was walking to meet Microsoft. And he's like, hey, tell me what you were building. And then we hit it off together. Like in those first two minutes, we're really good friends till today. And he's like, hey, I'm in, but let's meet in SF after South by. Everything was just like, you kind of make your own luck. I have this philosophy, like you have this grit and persistence, and then luck happens. That was like my first piece of luck. And then I went to SF and I went to meet him, and inside the meeting was another fund, Bullpen Capital, that he was meeting with. And then they're like, do you mind if we listen in? I'm like, sure. So I pitched them on AppBoy, and they're like, this is cool, we're in too. So right there, I got $500,000 of the $1 million round. And then I went back to Blumberg Capital. They decided to give me a term sheet. And then I raised from Metamorphic Ventures, who isn't, I don't even think they're around anymore, in New York. And we put $1 million round together on a $3 million pre.
Wow. Was this the 2012 round?
This happened in 2011. We closed it in the summer of 2011. I was still a solo founder and living in Houston. And then what happened was I needed to find my co-founders, and I'm not a technical guy. I'm a go-to-market builder and just really awesome at just building ideas. And I put some feelers out there, and my mentor, Bipul Sinha, who's now the CEO of Rubrik. So I told him, and he, again, this is where you create your own luck. I just put so many feelers out there. He was on a street corner in New York going to TechCrunch Disrupt in August of 2011. And Bill and John are standing there. John's on the phone with his girlfriend at the time, who's now his wife. And Bill's standing there, and Bipul's like, hey, my friend just raised $1 million. Super smart guy. He's looking for technical co-founders. You guys should connect with him. They're like, yeah, sure, we'll connect with him. And it happens to be John and Bill just won TechCrunch Disrupt at that time.
Oh, okay.
So that 2 weeks after that, we finally connected, and I met Bill first at Columbus Circle at a bar, and we hit it off. And then he introduced me to John, and then I brought them on as my co-founders. And I moved back to New York in like January of 2012. So like from 2008ish, late 2008ish to like end of 2011, just kind of tinkering on this. Got the seed round done, came back, and then we started building.
Was it prior to like raising the capital and getting the team together? Was it your full-time job, or was it still sort of on the side during that period until you raised money?
Once I closed the seed and I moved back to New York, I had to kind of cover the bases for the oil and gas company that I was helping manage in Houston. And one of my other cousins moved to the home. I was living in Houston. I left, so he took that over, and then it was full time from then on. So absolutely. Once I closed the seed, it really was now transitioning to full time.
And then you're in New York, and then in 2013 you raised your Series A. It looks like is that mostly insiders or new people?
No, so that's a whole story in itself. So we did $1 million seed, we did $1.5 million bridge in early 2012, and then we had to do the A, and nobody wanted to invest. We didn't have a term sheet. New York tech wasn't anything to talk about then. I always joke that it was just guilt and us. You didn't have any real funds out here. You had Union Square Ventures. Obviously they're real. But you didn't have there wasn't much going on here. It was like Boston or SF, right? All our competitors were, the pedigree of the founders were like out of Stanford or Harvard, and they raised money from Sequoia, from Kleiner. And here we are, three guys that don't have any startup background in New York, and nobody wanted to give us a term sheet. We had 2 weeks left of payroll, and Rally Ventures, Tom Peterson calls me, and he was passing. That was the last VC. I must have spoke to like 20 funds at the time, and I was in New York, and he's like, I'm passing. I'm like, why are you passing? He's like, oh, it's the valuation. I'm like, if you like the company, I'll come meet you tomorrow. He's like, I'm happy to meet you. So I flew out that day straight from my office to SF, and we just spoke, and we figured out the valuation that made sense for him and for us, and we got it done. But we had like 2 weeks left of payroll.
Wow.
Which a lot of people don't realize. Like, it's like the company.
I didn't know that.
So and there's like so many stories like that.
Round? I'm assuming he was leading it, but how big did that A end up being?
It was a $5 million round.
Okay.
So not a lot of money, but still enough which I think was the size of A's then. Like seed rounds then were not very big. Like there were maybe $1 million to $2.5 million. Your A was then 5 to 8 million, and then your B was probably larger and so on. And then you just didn't need a lot of money to like build companies. You just needed to hire people. Salaries weren't so as high as they are today. It was a very different world building in 2012 than building now in 2025 or 2024.
And what made the A difficult? Was it that you didn't quite have the metrics? You were already in?
Still like a little early with revenue. We had 2 competitors that I would say top funds backed, and we were the underdogs that no one really was paying attention to. I think a lot of people didn't really appreciate the TAM, which I think goes back to, I forgot which investor it was, but he mentioned that like VCs looking at TAM too much can really hurt them, because if you really believe in the idea, the TAM, they should actually increase the TAM, which is exactly what happened to us. Like we were building mobile lifecycle marketing and people are like, mobile, I don't get it. Exact Target at the time was purchased by Salesforce for a couple $1 billion. They're like, okay, we could probably see you getting to 20 million AR, 100 million AR at most. This isn't a big company, and you have Kahuna, who's Sequoia backed, and Lean Plum, Kleiner backed, and we're not gonna like compete with these guys. So like it was really hard to get the A, but we knew that mobile lifecycle marketing, like mobile's taking over the world. Like it wasn't just your desktop and laptop anymore. You have your iPhone, you have your iPad, you have Apple TV, you have a watch, you have all the Android devices. Of course it's coming. And for some odd whatever reason, investors thought that mobile wasn't going to be that large. From a software play. Maybe consumer plays, they thought it was going to be big, but not from a software.
I heard probably one of the craziest stories. I won't name the VC firm. Might be easy to guess, but very, very large, New York based. And they owned a ton of Facebook, now Meta. And they, I guess, had an argument at the partner level about when to sell. It was public now, and they were, went with it through Pre-IPO and the IPO. And they ended up selling because they didn't believe in the future of mobile at, like, I want to say, I might be butchering this, either $25 or $250, the 25 sticking out at me. And now look at it. Like, I was like, that's crazy. They sold all of it. Like, didn't believe in mobile. Nuts. Yeah.
Yeah.
So you, from the Series A, and then it seems like you quickly raised, or maybe within a year or so, the Series B. So had you hit that inflection point? Like you were able to secure...
We started, I think we to the credit of the funds that passed, we were too early. In the cycle of mobile, you had mobile get introduced, then everybody was making mobile apps, and it got very democratized. There were a lot of tools to help you make mobile apps. And then it was all about analytics and customer acquisition and attribution. Nothing about customer retention, right? And our vision was like, holy shit, this is going to be all about customer retention. And that's all it's going to count. Like, paying X amount for a customer acquisition, you're not doing anything to retain them, is crazy. But we were a couple years too early from the seed to the Series A. But we just kept our heads down and said, we're just going to build the best platform. And we had this thesis of like Swiss Army knives. No one's buying Swiss Army knives anymore. Everyone's buying like best in class tools. And we were too early. And as soon as the market tilted in our favor, we were gone. Like it was like, and then everybody else tried to come into our space. So all the analytical platforms are trying to come into our space. The A/B platforms are trying to come into our space. The attribution companies were trying to come into our space. But because we built such a core platform that was best in class, no one could penetrate us. But it was whack-a-mole. We always joke that it was whack-a-mole with all our competitors. Like every day we had someone else pop up.
What is your, I guess, like pattern with that? Do you just put your head down and say, we're going to destroy them? Or what's your self-talk?
Yeah, we just like, this is war. I remember just telling the team, this is war. Like we're once we get one out, there's another one that's going to come right after us. Because typically what happens is once a startup figures out product market fit, and then there's a wave, like there's like a ripple effect within the market. People hear about it, and then a lot of founders, what the problem they have is they just start chasing what's hot. So they forget about what the original thesis was, and they start coming into it. The hardest part with a founder in general is staying focused on your thesis and your idea. And I'm not saying you don't iterate between there, but you should stay focused on what you're building. And I think a lot of times they make that mistake. We just stayed focused. We're like, they're going to come at us. We have something good here. We know the market. We know that this can be a massive company. And we just stayed focused. That's something I try to work with all my portfolio companies here is like, I have one portfolio company that every time I talk to them, they're switching lanes of what they're building. And I'm like, look, I totally get that you need to do this. We're iterating, but eventually your sales team has no idea what they're selling. Your marketing team has no idea what content they're creating. Your engineering team is like, what the fuck are we building? Eventually, you're going to be 18 months in, you burn through all this money, you have nothing. So just pick a lane, even if it's right or wrong. Let's pick a lane and push the gas. And I think that's like one of the things that I really hone in on with a lot of my portfolio companies, and anything I do with our incubated companies we do at the fund now.
So that's super helpful. So now we're headed towards the Series C. You get Battery Ventures, which seems like a first kind of outsider and more of a growthy fund. At the stage of walk me through, like, where was the company at that point? And also, where was your headspace? Because you built this to be, I'm assuming, pretty big at that point.
Yeah, we actually, in between there, we had the B from InterWest.
Right. Yeah. Okay. Yeah.
So I just want to bring that up because Doug is now at ICONIQ Capital. He was very instrumental in what we built.
Oh, whoa. Okay. Yeah.
So he was awesome. So we did the B, and then fast forward to the C. What happened, the hardest part that happened with the C was similar to kind of where SaaS is today, where there was just a dip in the macro economy with SaaS multiples. We went out there, we were talking to tier A funds, hot and heavy. The public markets crashed. And then again, similar to the A, we had no one. And eventually we were able to get a term sheet from Battery. And it was only because I built this relationship with Neeraj and the team there for our A, our B, and our C, and they finally came in on the C. The company was, I think at the time, over 20 million AR and growing. I could be wrong. I don't remember exact figures, but we did a $20 million C. And now I think that's really another inflection point for the company is like, once we did that, the D was with ICONIQ. And we did a massive round with them, and then the E was with Meritech, and that was the last round that the company did before the IPO.
It's crazy that you raised what in total, 175 million before the IPO?
180 million. And at the time of the IPO, we still had, I think, about 80 million of that on the balance sheet. So that's also something with all these companies raising a shitload of money today. I'm like, I have no idea what they're doing with it.
Yeah, I was to give us your feedback. I guess one question first on just relationships. It sounds like you really tried to keep people close and cultivate those relationships, which worked out for you, especially when it wasn't always a hot round.
It's all about relationships, and I think a lot of founders underestimate that. I think like for me, even Doug Pepper, once I closed my seed round with Bloomberg Capital, Bruce Terrigan introduced me to Doug Pepper. We kept in touch all the way from the seed to the Series B, and he led our B. And then the same thing with the Series C with Battery Ventures. I met him for my A, he passed. I met him for my B, he passed. He came in on the C. And Meritech, actually, I met for the B as well. I remember going to their offices. We kept in touch, and they came in and led our E.
For founders listening, what does keeping in touch mean? Does that mean you add them to investor updates? Do you see them for coffee once a quarter?
I think you can brag, right? So like when you have big wins, send it to them. You just close a massive deal, forward it to them. Say, we just closed this deal, 100K ACV, 250K ACV, 60K ACV. Like, we're kicking ass. Like, just create some FOMO with them. I did a good job of like getting on text with them and being in touch, letting them know when I'm in town. I'd love to grab a coffee, grab a beer. When I'm hiring, I would send them an email. Hey, do you know anyone in your network that would be a great hire for this position? Just create reasons to reach out and create a rapport with them. So when you do meet them, they already know you. And so you don't have to get past that. First, they're investing in the founder, right? So if they already know you and they like you, now you just got to convince them that what you're working on is awesome and it's going to be massive. So I think that's something that I encourage all my founders to do is like build relationships with great VCs out there, because they're in the business of like building relationship with founders too. Like they have to. If they're not doing their job. So absolutely, this is all a relationship business for the founders and for the investors.
So it sounds like, I think the Series D and E, correct me if I'm wrong, decided to step down as CEO. You brought someone else in. What was that experience?
Yeah, actually Bill, who was my co-founder, CTO, he became CEO.
Oh, okay.
So it was just like a little bit of like magical chairs. He became CEO. John was CIO. He became CTO. Miles was our CRO. He became president. And I became executive chairman. My ego like really didn't want that, but I think it made sense. So if you look back now, obviously it was the right decisions. The company's doing amazing. Bill as the CEO, our co-founders are still there. And it was an interesting time. Like I'm a builder. I love 0 to 1, 1 to 10, 10 to 100. And we'll talk about that a little later, but yeah, that's what I really love doing. And I think like I obviously started it a little earlier than them from 2008. to 2011, and then they came in, and at a certain point, it was just kind of turning into something that maybe I wasn't as excited about in terms of running. I'm an idea guy. Like, we can talk about ideas all day. And Bill and John, I think and Miles, the three of them were probably more equipped to now take it from where we had it to the IPO.
It's interesting you learn a lot about yourself during those moments. Like, where am I great? What do I enjoy? Sometimes those can be different. And you started, a venture fund, which you had been investing for a long time. Would you touch on starting MXV and like what led to that?
Yeah, you know what? I love the early days. So I was doing a lot of angel investing as CEO of Braze when I was there. Very early in companies like Lattice. I was early in Nutanix, ThoughtSpot, Outreach, and a whole bunch of companies. And it was really just like, I just loved it. Like getting in early and being that early in those companies and building a company from 0 to 1 to 10, and so on. I just wanted to launch a fund. I think when we knew we were going to IPO, I was like, okay, I think I want to launch a fund now. It was late 2021, but I also wanted to build, because I do love starting companies. So I wanted to create some form of a hybrid. It is hard, but we launched MXV Capital, $52 million fund one. Today, we're about halfway through the fund. We have 2 incubated companies that I'm running as well. And then we come in super early, like pre-seed seed, and we're founder operators, and we lean in. We lean in super hard with our founders.
What's harder? Well, what was harder, raising your first fund or raising the seed round, the early stage rounds for Braze?
Funds are hard. I'll tell you why. There's no sense of urgency on the LP side. So they're willing to just wait and wait and wait. Whereas like a founder for a company, startup, you're like, I'm closing this round. Like you can create some sense of urgency around the table. And as soon as you get a lead, either other investors are in or they're out. They're both equally as challenging. And our first close was like 13 million for my fund, and we went all the way up to 52. It's a longer raising cycle, if that's a word or a term. Whereas I think like the software companies and just starting a startup is like, you need to close it in like 3 months. It's like, that's it. You don't have a choice, right?
Yeah. Or else it's a negative signal. If you're still out there.
Yeah. I don't know which is harder. I think there's probably more stress on the founding side of a startup, to be honest with you, because you're like, your company is dead or alive, right?
Right. With funds, at least, they might take a year or two to raise in some cases.
Yeah.
And once they're raised, they're 10 to 15 year fund life cycle. So you're like, okay, great. Oof, we're in business for at least a couple of years. Whereas with a startup, like you could burn through the capital in 16 months and then there might not be any more, and that's it. And there's a lot of people to manage.
I will say the hard part of a manager when you love operating is not operating all the companies you're investing in.
Yes.
So like I love early stage, but sometimes I just want to like jump through the screen and take over these companies and like run them. Which I don't know if that's a good thing, but I just love the early days and I love building. So I wish there were like, I joke with my wife, I wish there were like 10 of me so I could just go do like all these things that I want to do.
No, that's amazing. So in rounding all of this out, general feedback that maybe we didn't touch on to founders going out and raising, whether it's a first round of funding or future funding when things are really hard, like any tips?
I think it's hard, so don't expect it to be easy. I always tell our founders, like, remember why you started this, like what it is. You just need to find someone that shares that same passion of what you're building. Don't waste your time with VC funds that may not be interested in your space. What's unfortunate, there's a lot of funds out there that just don't tell you no up front. Yeah, but you probably know as a founder which ones are a no. And I would say focus on the ones that are very interested in you as a founder and interested in you, in what you're building. I think it's really important to be very diligent and run a process, especially in this market. Like, I think there used to be like a 10-to-1 ratio. I think it's probably closer to 20-to-1 now in terms of who you reach out to. And I think you need to do your homework on the funds that you're going after. Anywhere you can get a recommendation or an intro, I would focus on those as well. It's hard, and I don't think it gets easier. I think a lot of founders kind of read about all these companies raising money and raising their neck rounds. If it was easy, everyone would do it, right? And I think it's just like, you know what you're getting into, and it's hard, and don't expect it to be easy. And even if you're second-time founders, I think it's even harder the second time around, because as a first-time founder, you just don't know what's on the other side of the wall. So you just run through it. So sometimes I wonder if like first-time founders are better than second, to be honest with you.
Yeah, I think the verdict might be out. One thing I wanted to double click on, you said founders just raised way too much money and that Braze had a pretty large balance sheet. Like In terms of just round sizes, like what is your guidance there?
Raise what you need. Like I think like a lot of times some funds will push you to raise more. A lot of things happen when you raise too much money. One, there's no sense of urgency on your part to really figure out product market fit, your ICP, because you just kind of have some more leniency on your time. Second, when you raise a lot of money, there's more expectations for the next round, not even just in terms of value creation, but if you're a software company, the ARR that you would need to represent after raising, let's say $10 million or $20 million, whatever the round is, there's just more that you expect as a growth investor in terms of how much you raise. I think it's important to raise the amount you need and be really thoughtful about the valuation that you're raising at. There's public markets average SaaS companies trading at about 6x today. And some of these companies are growing 20-30% year over year. I think there's a really big misalignment right now in like for venture and the macro economy. Maybe that will change over time. All these growth investors investing at 20, 30, 40x multiples. I'm curious what the outcome of those companies will be when the macro economy is at 6, 7x. As a founder, you need to be thinking about that as well.
Yeah, that's super helpful. This was fantastic. Thank you much, Mark, for sharing your story and giving us the scoop. It was awesome.
Awesome. Thank you.
Earlier this year, I was in a pinch. I was hiring my first full-time hire and didn't have payroll set up. I posted a quick message on X asking for the best company to help me get up and running, and everyone quickly recommended Warp. Within a few hours, I was up and running with payroll and benefits and able to onboard my team. Warp is one of the few platforms that allows you to offer healthcare with a minimum of 2 employees. It has coverage across 50 states, manages all state tax compliance, offers health and 401k benefits, and with no strings attached. For a limited time, get a free AirPods 4 when you click the link below in the show notes to learn more about Warp. It's difficult to find the right banking partner. I was very fortunate to find Stifel Bank. Stifel's venture banking team is your trusted partner for a full range of banking solutions for both venture-backed companies and venture funds. Stifel Venture Banking supports seed through late-stage companies, providing solutions for treasury management, strategic lending, and tailored banking offerings. Check out stifelventurebanking.com to see how they can help you reach new heights. Stifel Venture Banking is a division of Stifel Bank, member FDIC. You can find the link below in show notes.